Welcome back, everyone. Today, we're going to talk about the 30 to 40 million people that are at risk for eviction. Let's get started. Welcome back, everyone. So today's episode is a really interesting one with the upcoming election change, policy changes, the unknown of a stimulus, which will probably keep going, and a number of unknowns within the rental space. We have to talk about the looming risk, right? And I think you often hear about the risk of foreclosures. There's going to be a crash in the housing market. Frankly, those that are talking at that high level conceptual sort of mindset are not digging deep enough to really understand the nuances that are going to affect this market. And I've been saying, since really, April, May, that sure, there's going to be a housing crash. And I've been saying, but it's not going to be as broad sweeping as we think. It's not going to hit every market, and it's only going to hit certain product types, right? And so far, my prediction has been spot on. I continue to believe that the majority, and we'll get to the stats here in a second, but the majority of foreclosure risk, the majority of eviction risk, right, and homelessness is going to happen in, unfortunately, the less affluent class. So think of C and D class properties. Now, if you got Section 8 as a C or D class property, hats off to you. You're positioned quite well to continue to get some sort of payment in your rent. If you're not and you own C and D class, I think you have real risk in your portfolio, and you really want to make sure that you're managing your cash. So a few stats that I read today from the Wall Street Journal, right? By the end of 2020, there's an estimated 12.8 million people that will be behind on their rent by around $5,500. And what they're doing is they're beginning to shift their payments for other things into credit card debt to be able to keep their rent. Now, we know in classic recessions, and Ray Dalio goes on to explain this. And by the way, on our YouTube channel, if you go down to the experts section, you'll see a fantastic video by Ray Dalio, 30 minutes long. It talks about how the economy works. And one of the concepts in here is this idea of a debt bubble, right? And essentially, you'll see it, whether it be on signs, on billboards that say, no interest for 18 months, big furniture deals, 4 years, no interest, 0% financing for car loans, all these sort of, incentives. Once that happens, it's a sign of a growing debt bubble. Another one to look at is credit card debt levels. And we're beginning to see in that C and D class an expansion of credit card debt. This is high leverage. They're going to have issues at some point paying down their debt. And there's a looming problem with tenants in the eviction risk. Again, you're not seeing this so much in the upper A and B class product types, and you're not seeing it in the economies that have diverse economies. So my philosophy, my strategy of investing has been exactly spot on. And, again, let's go through some more stats, okay? So again, the current eviction, protection, if you will, expires in January. Now, if Trump wins, likely, if the Senate wins as well, with Republican, then there's a good chance sweeping stimulus will happen very quickly. If not, you're going to see some sort of lame duck scenarios where it's going to take a long time to get these stimulus packages passed. Now, if Biden wins and Senate flips to Democrat, which is looking possible, again, I think you're going to see stimulus kind of sweep through, and it will probably become pro-tenant. Now, if Biden wins and if Senate becomes Democrat, and if they push through pro-tenant policies, especially at the state level, who's going to hurt? The landlords. Now, about 3 months ago, I talked to a friend of mine who runs a rather large debt fund, and it's large. And they're actually waiting for about 2 to 3 months from now. And what they're expecting, and at least what they're aiming for, is a lot of these mom and pop investors that are in the C and D class categories that are in trouble, unable to afford their mortgage payments. They're going to be sweeping in to pick up these portfolio purchases at 40 to 50% discounted to what they are today. So when you think about foreclosures, when you think about housing crashes, the people we're talking about, Seattle and New York, San Francisco, yes, there is pressure, there's headwinds in those markets. You're going to see corrections. but that's not where the opportunity lies. And for those that are talking about that, I really encourage you to ignore them, because they're not digging in enough. They're being lazy. That's not where you're going to make the most money here. Where you're going to make the most money here is focusing on the stats that show which cities have the most amount of C and D class renters, primarily cities that have, a heavy focus in, hospitality, entertainment, travel and tourism. Look for those economies and in the C class areas, and try to find, deals in those areas. And it's not here yet, but sometime around the end of the year, going into Q1 of next year, I think you'll see a wave of inventory in that area. I still hold firm that in the $250,000 to $400,000 price point, A and B class, I think you're going to be just fine, and we're going to see appreciation in those categories. So again, 30 to 40 million people is the total risk right now in foreclosure. 12.8 million by the end of this year will have almost $6,000 in debt for rent. That's about 5 or 6 months worth of rent. They're not going to be able to pay that back. Someone's going to have to foot the bill. It's going to be the landlords, so pay attention to that. So with that said, we're going to be digging deeper in our masterclass. And any of you out there that are going into the next year wanting to get started in investing, wanting to build your passive income portfolio, look, if you really want to get started right, learn from people like myself. Learn from those that have gone through the mistakes over. I've been this for almost 12 years now, and I have made plenty of mistakes, and they can be costly. So I encourage you to take our masterclass. It's 14 lessons, over 4 hours of content. You get 9 different tools to help you analyze deals and everything else. And you also get a half an hour with me. So once you're done with it, you and I will sit down and plan your strategy. So be sure to think about 2020. How are you going to capitalize on this foreclosure wave? What's your strategy to capitalize on the distressed values of assets? Remember, the rich get richer in times of stress because they pick up distressed assets and they sell at a higher price point. That's true of any asset class, okay? So with that said, give it a thumbs up or not, and I'm curious to get your thoughts on what you think is going to be happening with these foreclosures and evictions. So talk soon. Thanks.